Today, we will talk about managing business cash flow. What is cash flow? Simply put, cash flow refers to the amount of cash that goes in and out of a company's coffers during a given period of time. Normally, you will find three types of cash flow on a cash flow statement. Cash flow from operations. This is the money generated, spent, or lost in the course of a company's main business activities. Cash flow from investments. This is the money coming in or going out of the company that is related to the purchase and sale of long-term investments, such as property, buildings, and equipment. Cash flow from financing. This category includes all flows related to raising cash, as well as paying back debts to investors and creditors. Although not usually listed on a cash flow statement, one could add a fourth type, free cash flow. That's the cash that a company has left over after accounting for operating expenses and capital expenditures. It should not be confused with net cash flow, which is listed on a cash flow statement and refers to the sum of the three categories above. Can cash flow be negative? Since a company's net cash flow is a sum of three different positive or negative figures, cash flow can turn out to be negative. When this happens, it means there is more cash leaving the company than there is cash coming in. This situation can spell financial trouble, of course, but it need not always be negative in the colloquial sense, explains Karanjit Singh Kochhar, Manager, Major Accounts, BDC. It can also be a sign of seasonality, he says, referring to businesses like a snow-clearing company or ice cream shop that have high and low seasons, resulting in higher expenditures and lower revenues depending on the time of year. How to prepare an annual cash flow budget. A cash flow budget estimates all cash receipts and expenditures that are expected to occur during a given period. It can help you make sure you have cash on hand when, for instance, there's a big order coming up and you need to buy large amounts of inventory. To prepare an annual cash flow budget, you essentially need to write down all estimated future income and expenditures. Amongst other advantages, doing a cash flow budget helps business owners understand their borrowing requirements, explains Kochhar. With a budget in hand, the next step is to compare actual results with your budget on a monthly basis. Businesses will usually use management reports and performance dashboards to keep track of key performance indicators, such as the health of their cash flow. What is a cash flow loan used for? A cash flow loan, also known as a working capital loan, does not require collateral, such as a machine or building, and is approved based on the strength of a business's operating cash flow. These loans can be used to finance growth projects, such as marketing campaigns, product research, or the hiring of salespeople. They are also commonly used when a business goes through an ownership change. Here are 5 tips to manage your cash flow. 1. Tailor your customers' payment terms to your vendor's term. The quicker you collect, the better your cash flow will be. That's because you're turning an expected revenue into actual cash, explains Kochhar. As a general rule, try to match the payment terms you offer to your clients to the terms offered by your suppliers. To be more specific, don't extend your customers' terms above and beyond what your vendors are offering you. For example, if your vendors are expecting payment within 30 days while you are asking your clients to pay within 90 days, your cash flow will be negatively affected. To improve your cash flow, adjust your terms to 30 days. 2. Offer early payment discounts. Another simple way to improve cash flow is to offer early payment discounts to your customers. Early payment discounts are those that vendors or suppliers offer to their customers to pay their invoices or bills within a certain period. For example, you could offer a discount of 2% if the clients pay within 10 days, Kochhar says. Conversely, you can charge interest if the client pays in 90 days, since your terms stipulated that payment had to be made within 30. Both approaches create a strong incentive for customers to pay their bills early, which helps your cash flow by bringing in the money sooner. And if the bill is paid late, the interest charged means there is some extra cash on hand when a payment is eventually made. 3. Take the longest possible amortization on loans. Choosing the longest possible amortization period on a loan reduces each payment and allows businesses to have more financial flexibility. My advice is to take longer amortizations, but to make extra payments during periods of stronger cash flow, suggests Kochhar. It helps preserve healthy cash flow during periods when money is tighter. 4. Complete a cash flow projection. Prepare a cash flow projection for the coming year. Using a spreadsheet or accounting software, write down expected monthly cash inflows and outflows, including anticipated big-ticket purchases. These projections will allow you to anticipate slow periods and work out solutions in advance. This becomes especially important in a seasonal business when you have highs and lows throughout the year, Kocher says. Looking historically at how much you make and spend will allow you to plan accordingly and be prepared for the future. 5. Choose and use the right tools. There are 3 types of tools that can be useful for managing cash flow: accounting software, cash flow planners, and dashboards. Accounting software helps prepare cash flow projections, track your bills to avoid late fees and interest, and track unpaid accounts. However, you'll need the right tool for the job. Cash flow planners are spreadsheets comparing all the money coming in and going out of your business over a given period. They help you determine how much cash you can expect to have in your bank account at the end of that period. They help ensure you have sufficient cash to pay your bills and avoid a cash flow crunch. Dashboards are a component of accounting software and list incoming and outgoing money for the previous month. They help you understand your cash position. They're a powerful tool, says Kocher. You may think you're in a great position because you just made a sale of $100,000 with a 20% profit margin, but dashboards will remind you that your bank account is negative $70,000 because you have not collected the money yet. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.